In Lesson 4, we're going to make sure that you understand that Forex trading occurs on leverage, what leverage is, and how to know how much you're using. By definition, leverage is the use of various financial instruments or borrowed capital, such as margin, to increase potential return of an investment. The most common form of leverage is a mortgage. When somebody purchases a home, they're usually only putting down 20% of the value of the home, or maybe even less. However, even though they put down 20% of the home, they're subject to profit and loss on the entire value of the home, and that's part of what got us into trouble in the late 2000s with the real estate bubble. Forex works in the same way. You put a small amount of money down, and you can trade a very large amount of money. Leverage does open the door for abnormally large profits, but it does the opposite as well. It's a double-edged sword. Trading on leverage can mean excessive losses, especially to those that are accustomed to taking on too much risk. Keep in mind, the lower the margin requirement that your brokerage firm charges you, the higher leverage ratio you're working off of, and in turn, the more risk and maybe the more reward that you're facing. The NFA now limits leverage to 50 to 1 for Forex traders in the United States, but this wasn't always the case. The Forex industry was built on the premise of undercutting the futures industry in regards to margin requirements. Early on, 100 to 1 or even as high as 400 to 1 leverage ratios were offered to clients. In my opinion, high leverage is great for brokers, but maybe not so much for retail traders. Lower margin requirements and therefore higher leverage ratios tend to breed over trading. They encourage clients to take on too much risk, and they usually end in disaster. I compare choosing to trade on maximum leverage as being similar to choosing an item on the fast food menu that has the most fat. The decision has the potential to provide immediate gratification, but in the end, the result is rarely a positive one. A good way to keep your leverage ratio low, regardless of the brokerage firm or the government or whatever leverage ratio you're provided, if you simply overfund the account, you're lowering your leverage and you're lowering your risk. And when I say overfund the account, I mean if the margin requirement on a contract is $2,000, make sure you have $10,000 in the account. You're giving yourself more room for error, you're lowering your leverage, and in the long run, you'll probably be better off. For those of you that are not aware of the NFA is the National Futures Association. They're the regulatory body that oversees the futures and options industry, and they now also oversee the Forex markets. We know that the NFA limits leverage ratios to 50 to 1 in the US, but what really does that mean? Well, I'll tell you. It means that a trader can buy or sell $100,000 worth of currency for just $2,000. In other words, for every dollar they put up, they're able to trade $50 worth of currency. If you wanted to do this math yourself, you simply take $100,000 divided by 50, and you get 2,000. Before the NFA limited leverage to 50 to 1, the rule was actually 100 to 1. And in fact, most brokerage firms offered 100 to 1, which meant that a trader could put down $1,000 and trade $100,000. In other words, they're putting $1,000, but they're making or losing money based on $100,000 worth of currency. We mentioned that some brokerage firms went as far as offering 400 to 1. And 400 to 1 leverage means that a trader could have put down $250 and made or lost money based on $100,000 worth of currency. Do you really think that anyone could possibly make money with this much leverage? I have my doubts. It offers very little room for error. If you think about it, $250 is equivalent to about 25 ticks. Remember, each tick or pip in the Forex market is 1/100th of a percent. There are essentially three factors that determine margin. There's leverage ratio, which is set by the NFA at 50 to 1. It probably isn't going to change anytime soon. There's the notional value, which is the entire value of the position ignoring leverage. And what this means is if the euro is trading at $1.40, we know that 1 euro is equivalent to $1.40 in US dollars. Therefore, if you're trading 100,000 units, which is the standard size in Forex, the value of that contract is 140,000. Obviously, as a trader, you would be able to trade that contract worth 140,000 for much less, probably more like 2,000 or 3,000. But the notional value is the entire value. The 140,000, that's the notional value. The third determining factor is the exchange rate of the US dollar, if the US dollar is the base currency and not the quote currency. In other words, if the dollar is listed first in the pair and not second, then that pair is expressed in terms of the foreign currency. And in order for you to determine what the actual margin requirement is going to be in dollars, you have to first convert the notional value, which is stated in the foreign currency, to US dollars. This can get a little complicated. In fact, it can get so complicated that a lot of beginning traders just say, forget about it. I'm only going to trade currency pairs in which the dollar is the quote currency. For the sake of simplicity, we're going to use the euro dollar, and also we mentioned before, it is the most popular. Assuming a margin requirement or a leverage ratio of 50 to 1, if the euro is trading at 135.50, and remember this simply means 1 euro is equal to $1.35.5. If the euro is trading at 135.50, the notional value of the contract is 135,550, and that's because we're assuming that we're trading a standard lot, which is 100,000 units. The margin requirement on this trade is $2,711. We get that by dividing the notional value by 50, or you can look at it another way and you can say we're multiplying the notional value times the leverage ratio, which is 1 over 50. It's a fraction. And as we mentioned before, margin requirements in the Forex market are not set. They're not static like they are in futures. They change with the market. They change with the value of the market. If the euro dollar was trading at 145.50 instead of 135.50, which is exactly a dime higher in price, the margin requirement goes up to $2,911. If the euro was trading at 125.50, the margin requirement would be less than the original figure of 2,700. Again, the margin requirement is going to fluctuate with the market, so it's changing every second of the day that the market's open, which is basically 24 hours a day, ignoring Friday night through Sunday afternoon. Let's go back to a live trading platform and take a look at just how much of an impact leverage can have on your trading and how quickly you can make or lose money in the Forex markets. In this day and age, calculators are basically obsolete, right? If we need the answer to something, we simply go online and we find it. Forex margin calculations are no exception. There's several websites out there that offer free calculators to traders. You simply enter in a couple of parameters, you hit the return button, and there you've got your answer. No need to go through the complex math problems that we just showed you. Okay, maybe they're not so complex, but they are math, and math does scare people. So here's an easier way to find the answer. I chose FXStreet.com simply because they are not owned and operated by any other brokerage firm. They're a third party, they're independent, and they do a good job. If you go to the home page of FXStreet.com, start by clicking on the Tools menu, and the first thing that comes up is trading calculators. For now, we're going to focus on margin. I'll go ahead and zoom in the screen to make sure that everybody can see. And it defaults to the euro dollar, probably because that's the most traded currency pair. You probably remember me mentioning that the margin requirement is going to be dependent on 3 things. And one of those things being the current rate, what the current market price is. The other being the number of units you're trading. Are you trading a mini lot, which is 10,000 units? Are you trading a standard lot, which is 100,000 units? Are you trading something in between, or are you trading more? And the third being the margin ratio. Now, if you're trading with a U.S. brokerage firm, you're going to be trading at a 50-to-1 leverage ratio. Other brokerage firms overseas might provide higher leverage ratios. Is this in the best interest of the client? Probably not. And if you're thinking about opening an account overseas so that you can utilize those types of leverage requirements, think again. The NFA's thought of that, and they are basically in cahoots with all foreign brokers, and so even if you open an account with a foreign broker, they're going to hold you to the 50-to-1. Let's assume that we're trading a standard lot, which is 100,000 units. Let's go ahead and calculate what the margin requirement would have been when the euro was at 160. And it's as easy as that. You hit the button that says calculate, and here you go. There's your answer. $3,200. Now 160 is actually a very high price for the euro. 130 is maybe a little more comfortable. 2,600. I remember a lot of analysts saying the euro is going to par. The euro is doomed. Well, it might happen. And if it does, the margin requirement will be 2,000. So you can see here it's very obvious that as the price of the euro goes up, so does the margin requirement, because the notional value of the trade is higher. You remember, the notional value is simply the value of the contract without leverage. So if we're talking about 100,000 units and the value of the contract is at $1, we're at par, we're talking about $100,000 worth of currency. If we're talking about the euro at 130, Now we're talking about $130,000 worth of currency, and the margin requirement is $2,600. Now that we understand that the margin requirement is going to fluctuate with the value of the contract itself, or the price of the euro itself, let's see what the margin ratio does to things. Let's see what a trader at a 200 to 1 leverage ratio would have to put down on 100,000 units worth of the currency. $650. And again, somebody trading at 50 to 1, $2,600 versus $650. You can see the massive difference in leverage. Somebody controlling $130,000 worth of a currency with $650, it's complete insanity.